You just heard the professor say we could have a 15% gain in stocks next year. Believable in your mind?
I think that that's asking for a lot. If we rally 15% from here, that would get us to just over 4,300. At 4,300, and on his earnings estimates, he talked about 220, 210. It would mean that we're trading at 20 times earnings. Which
he said is justified if you're going to have a recessionary environment.
Yes, but a recessionary environment usually involves earnings going down 30, 40%, really big washouts in earnings where it's such pent-up demand. But a slight decline in earnings, 220 is flat. So at flat earnings, you don't put a big multiple on that, mostly in the environment where you still have a Fed that's keeping rates very high.
All roads lead to the Fed.
Yes.
Obviously. And I'm not sure if you heard what he said about projecting a pivot at some point, that they're not going to be able to do what they say that they're going to do. He went even further, okay? I want you to listen to what Professor Siegel said about where rates are going to go. We'll talk on the other side.
I think we might see a 2 to 3% Fed funds rate by the end of the year. I think they're going to say, wow, we've really solved that inflation. I'm now a little worried about the unemployment and the buildup of that. And, the normal Fed funds rate, they say, is 2.5, for that 2% inflation. I actually think it's between 1.5 and 2. And I think they're going to get down toward that by the end of the year. It's not going to be near 5.
That's provocative, to say the least.
300 basis points of cuts, and let's assume that they're going to get to 5% in the first couple of months of next year, would be unprecedented given how much they say they are worried about inflation. Powell has said one phrase over and over again. It's that history warns against cutting too soon. And in a world where employment, they still say, is too tight, and even in their SEP projection, they have employment going from 3.7% this year to 4.6% next year. That means that they're still comfortable with employment going up by 100 basis points. So in that world where you would have to see employment be far worse than that 4.6% to get them cutting 300 basis points.
Okay, now you know what Powell has said over and over and over again. If the professor was here, he said inflation was going to be transitory. And they turned out to be wrong. So I don't believe what they say now. And I don't believe that they're going to be able to go as high as they say. And ultimately, they're not. And that's why stocks can have a better year than people think.
Well, I think that we have to be careful in trying to bet on that too soon. And I think that's been the lesson in the back half of 2022, is that you kept having these failed pivot rallies and these hopes of a pivot. And if you traded based on that and bought stocks thinking that the Fed was going to back away from its word, just like it did back last year and was wrong on inflation, now it's going to be wrong on the other side, you got caught flat-footed. And so I think as investors, we have to be as data dependent as the Fed is, full stop. And until the data is supportive of a pivot, we should not be betting on one.
What would turn you more positive? Is it a legitimate pivot, an actual beginning of cutting interest rates? What's that moment where you change your disposition about the market?
I think that it's when data starts getting bad enough that you start seeing cracks under the surface that really does support the Fed doing something different. But I think it's important to note that data still remains really strong. And maybe that is a reason why you're seeing some better stock action within the cyclicals right now, because they are pricing in the fact that data isn't rolling over. We're not going into an imminent recession next quarter. And so that probably could provide a lift to certain parts of the market. But then, of course, it's the matter of time to see the weakness eventually emerge as we stay in this very tighter for longer environment.
When some say there still exists a quote unquote generational opportunity in fixed income, you say what?
Well, I think that if it was a generational opportunity a couple of weeks ago, again, you got caught flat-footed. As data comes in better than expected, we've seen upward pressure on yields. So I think if you are a buyer who can lock in juicy yields in these high single digits ranges, great. That actually is very supportive for portfolios. We haven't seen that in ages. However, credit spreads for high yield are about 450 basis points. For investment grade, they're about 220 basis points. You are not being aggressively compensated for credit risk. Doesn't mean that yields in 8-9% still aren't great, but I think that you have to pick your spots carefully.
All right. All right. We'll talk to you many more times, I'm sure, in 2023. Happy New Year.
Happy New Year.